So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to The Daily Call from Option Alpha. Hey everyone, this is Kirk here again from Option Alpha, and welcome back to The Daily Call. Today we're answering the question, why do all out-of-the-money options expire worthless? So this is a common question that I get, honestly, from newbies. And the question is, well, why do these things expire worthless? Why don't they have any value at expiration? So why do we, in many cases, leave these out-of-the-money option contracts on to expire worthless, whether they're long contracts or short contracts? Why don't we just let them go through the expiration cycle or choose to exercise those contracts and deal with the shares? So I want to use an example which hopefully will illustrate this point very clearly as to why these option contracts expire worthless when they're out of the money. So let's say that you have a stock that's trading at $100 and you buy a 105 call option on that stock, right? So you might buy that call option. Of course, since we're at Option Alpha and we do option selling, we might be the person that sells you that option contract at $105 strike. Now, that $105 strike gives you the right, but not the obligation. So there's where your choice lays or lies. You have the right, but not the obligation to buy stock at $105 anytime between now and expiration. So the stock's trading at $100 right now. So clearly you're not going to buy stock or exercise that option contract right now, because then you'd be forced to buy stock at $105 when stock is trading at $100. So that would create a losing trade for you. You'd buy stock at 105, you'd sell it at 100, and you'd lose $5. So the value in that contract is obviously not at exercising the contract right then and there. There's got to be some sort of external or extrinsic value between now and expiration. And maybe you think that the stock is going to go much higher than $5, much more than $105 in the future. So now what you do is you say, okay, look, I'm going to buy this option contract at $105 strike, but I think that the stock is going to go up to 110 or 120 or 115, it doesn't really matter. But let's say you get all the way to expiration and the stock has now gone to $104. So it's actually moved up. It did what you thought it was going to do, but just didn't move up far enough. So your 105 strike is still out of the money. And it's out of the money because if you were to exercise that option contract, you would put yourself in a financial deficit or losing position willingly, which is what nobody would actually do. No rational person would actually do. So if you were to exercise your call option as the option buyer, you would buy stock at $105 and you would be forced in the open market to then immediately liquidate and sell that position for $104. Now, of course, you can hold on to the stock if you want to, but the idea is that if you are going to exercise your option contract, you're going to do it in a way that would be advantageous to you. So if you have to buy stock at 105, but it's trading in the open market for 104, why even deal with the option contract? Just go out into the open market and buy 100 shares at 104 and let the option contract expire worthless. So that's why options that are out of the money always expire worthless, because they, at expiration, if they are not in the money, they have no intrinsic value. And because they're at expiration, they have no extrinsic value. They've run out of time. Their life has come to an end, right? There's no more time. There's no more possibility that they could move higher or that they could be traded further out on the time horizon or duration. So those option contracts always expire out of the money and worthless. It's just exactly how it happens. So hopefully this helps out, just kind of, again, looking at a very simple example with a long call option. But what you have to realize is that for options to have any value, they have to have value intrinsically in the money value at expiration. If they don't, then they just expire worthless. So as always, hopefully this helps out. If you guys have any questions, let me know. Until next time, happy trading. Thanks for joining us on The Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on The Daily Call from OptionAlpha.com.